So as a conclusion of the financial statements, let's talk about who is checking all those statements and cash flow. This is where audit comes in. So the external auditor is there to give an opinion on whether the financial statements are presented fairly under the applicable accounting framework. And the best outcome would be the unqualified opinion. And when you hear it first, you might be like, oh, unqualified, that sounds a bit negative. In everyday language, it's true. But in reality, or at least in accounting, it simply means that there is no qualification. Unqualified is no but, because a qualification is there is something. So when the auditor finds a problem, this is when you get the qualified opinion, which is it's fairly presented except for this specific issue, this qualification, right? Then you have adverse opinion that is slightly, significantly below. It says it's not fairly presented. And the worst case is disclaimer of opinion. And basically the auditor is saying, I cannot give an opinion on those statements. So important thing is audits are not a guarantee that there is no fraud, because they are not going through every single invoice. The auditor is not checking every inventory item, it's not checking every contract. They take a sample. So what they really test is controls. They take a simple transaction and they look for inconsistencies. So it reduces the chance of misstatement, but it does not eliminate fraud risk. Also note that sometimes after, numbers can be restated. And this, you have different cases, but basically if there is an error or if there is a change of accounting principle, then past statements have also to be restated. If it's just something more minor, like a change in estimate, then it's only for future statements.